According to Munich Re's figures, natural disasters in 2025 caused 224 billion of US dollars in damages, with less than half of it covered by insurance. Increased global warming will cause significant GDP losses. While it is hard to put this into concrete figures, estimates range between 10 and 50%. The need to act is clearly visible. For the discussion today, we're joined by Mostafa Ziaee, AXA's lead for emerging markets alternative investments, to explore how infrastructure investments in emerging markets can contribute to resilience. Mostafa and I have a long-standing history because we both work together in the context of the Insurance Development Forum, a public-private partnership with the world's leading global insurers and brokers, together with the World Bank and other development finance institutions. The Insurance Development Forum is looking at how the insurance business can contribute to mitigating and adapting to risks resulting from climate change. And one of the areas the forum has been looking at a lot recently is infrastructure. And Mostafa and I cooperate together in the Infrastructure Task Force, one of whose projects was to launch a fund for insurers investing into emerging markets infrastructure contributing to resilience. Now, without further ado, Mostafa, maybe let's start off right away with one of the most central questions. A lot of discussion today is about making infrastructure resilient. What's the difference to resilience infrastructure? Is that the same or is there a difference?
Well, great to be with you, Heike. I think your question points to an important distinction that is sometimes missed in conversation and discussions about infrastructure and about resilience. Because for me, I see resilience infrastructure going one step beyond resilient infrastructure. So in all our investments, we are looking for investing in infrastructure that are resilient, because if not, those assets can be impacted by different events and are exposed to different risks that can disrupt their activities and affect the cash flow and the revenue generation and pose risk to investors. That is why we monitor these risks systematically across all our investments. The way we do it has evolved a lot over the past couple of years thanks to technological advancements, but that's a topic for another discussion. Resilience infrastructure is going one step beyond, meaning that we are investing in assets that are not only resilient themselves, but also contribute to the resilience of the communities that they serve.
So resilience infrastructure, how is AXA, how is your company engaging in this, and what is your role in this? I read your title, which basically said you're responsible for this, you're the man for it, but maybe you can give a bit more detail for everyone watching this video.
Yes, of course. So I think to answer this question, I need to add that while these two concepts are distinct, they are very much interconnected. So naturally, if an asset is supposed to be a resilience asset, meaning that contributing to the resilience of the local community, the asset in itself should be resilient, because if not, it cannot continue delivering the essential services or the services that it provides to the local community. So it's sort of like a necessary condition for any asset that wants to boost and improve the resilience of the community to be resilient in itself. Conversely, we often see that when an asset is contributing to the essential or critical services that the community needs, the asset itself becomes more resilient as well. That is because the incentives of the governments, the local community, and the investors match and align perfectly. So if the services that infrastructure is providing is disrupted, it can cause a lot of damage and problem for the local community. So the local community and the government and different players help the asset to continue functioning, making the asset itself more resilient.
You say that resilience investments are also more resilient because they are really what governments, what communities, what societies need. How does the role of AXA as big investor come into that? What is your perspective specifically as an investor, why this asset class is of interest?
So we call this kind of infrastructure core or essential infrastructure, and our strategy in general and in emerging market and developing economies in particular is focused on investing and financing these infrastructure. By doing so, we are getting double benefit. We are first investing in assets that are lower risk in their risk profile, but also we are financing and we are contributing to the life and improvement of life standard of the targeted communities. That is why at AXA we have a commitment to invest 500 million annually in investments and in infrastructure or other instruments that improve the resilience of local communities across the globe. And we see a significant benefit for us to continue investing in these resilience infrastructure and asset classes at a scale.
That's an interesting finding to say you have that commitment. But if you go into a room of big investors, including insurers, and you ask them, so how are you now positioned in infrastructure in emerging markets? You often see very blank faces and people say, oh no, we're not sure this is an asset class for us, or no, we don't do this yet. So are there also challenges associated with these types of investments, in particular when it comes to emerging markets? I mean, there's a lot to invest in infrastructure in our region as well. Why go ahead? Why go to emerging markets? And what are the challenges? How do you best deal with those?
So when we focus a bit on emerging market and developing economies, if we look at across asset classes, on public assets, we and all institutional investors have been investing in public assets for years. It's established asset class. We invest at a scale and regularly. When it comes to private assets like infrastructure, whether debt or equity, that is not the case. It has not evolved into an investable asset class for insurers and institutional investors. At AXA, we have started investing in these assets for the past 10 years, driven by our conviction that they can provide significant benefits to our investment portfolio. Like any other investors, in any investment decision, we are looking for mainly three things. First, attractive risk-adjusted returns, attractive risk-return profile. Second, financing future and future-proof assets. And third, diversification. It is often said that in finance, there is no free lunch except for diversification. And we think emerging market and developing economies, these fast-growing regions with untapped potential, can provide all these three. However, we have not been able to invest in these regions in private asset at a scale. We have invested, but it has always been great opportunistic one-off. It has not evolved into repeatable, scalable transaction. There are multiple reasons. For example, the risk profile of these assets, partly because of the inherent risk of these regions, partly because of the perception of risk that we have because of lack of track record, lack of data, and so on, means that usually the risk profile of infrastructure in emerging market falls outside our risk tolerance. So that's why we rely a lot on investments through blended finance solutions that have an embedded risk-sharing mechanism that blends public money to mobilize private capital. The issue with these investments or these structures are that they are overly complex. We need to spend much more time and effort than other investments, and each of them are unique. The next time we want to invest in the next opportunity, we have to start from scratch because it looks nothing like the previous opportunity that we have invested. That's one of the barriers that prevents this asset class to pick up as a scalable, repeatable transaction for us, evolving into something that we see in our asset allocation regularly.
So from a lawyer's perspective, I like that complex structures that have to be made from scratch each time. But I do recognize that's obviously not helpful in building that asset class. So what is a way of addressing this issue of scalability and repeatability? I hinted to the fund that we both have been working on, the Infrastructure Resilience Development Fund, initiated by the Insurance Development Forum. What is so special about this fund, and why could that be a blueprint for scalability and replicability?
So I think trying to answer this question has been our motivation to treat the investments in this area slightly different from our investments in other asset classes and in other regions. What I mean is that we are engaging in, I would say, somehow a market-making activity, trying to support establishing these asset classes, these assets as asset classes investable by institutional investors and insurers. That is why we engage a lot, for example, with MDBs through World Bank Private Sector Investment Lab. We engage also with our industry peers through Insurance Development Forum, as you mentioned at the beginning, in Infrastructure Task Force, where we benefited a lot from your support and leadership as the co-chair. We have been thinking how we can solve this, how we can address it, how we can bring forward a scalable, repeatable solution. For the last 2 to 3 years, we have been designing and thinking and developing a blueprint. And last year, we launched a fund called Infrastructure Resilient Development Fund, together with 5 other global insurers, all members of Insurance Development Forum, and with the support and help of the a global asset manager, BlackRock. This fund is a blended finance infrastructure debt fund that will invest in emerging market and developing economies in Asia, in Africa, and in Latin America. What makes this fund unique is that it's very rare that 6 institutional investors, 6 insurers come together, say that we want to develop something, we want to invest in something that we do not usually invest. We want to share our expertise to develop this. We partner with an asset manager to help us develop this. We invest in it, and we support its growth and its scalability. For me, there are 2 important uniqueness about IRDF. First, these 6 insurers, we operate under slightly different models, but at the end, our investment objectives and criteria are very much alike. If we could invest, if we saw this investment fitting our criteria, it means that many other investors can join. So this is scalable. For these 6 investors and other investors who will join this fund, they can also invest in other funds in the future that are developed and structured based on same principle. So it is repeatable. So that's why I think this fund is a real breakthrough that provides an innovative solution that is replicable and scalable and can support establishing an asset class for insurers and institutional investors to invest at a scale in emerging market and developing economies.
Taking that as a starting point to look a bit into the future, we heard this is a breakthrough. The fund was launched in October last year. Still fundraising for anyone who has a bit of pocket money ready for this interesting new asset class. How do you expect the industry to approach the topic over the next 5 to 10 years? What do you expect to be happening? What are the main preconditions for this to happen?
So I would say, as we discussed, one of the main issues or barriers that we have is the duality between our perception of risk based on the data and track record available and the reality of the risk on the ground. The very few data points and a scarce track record that we have and the industry has implies that this gap is sizable. I think as blended finance solutions like IRDF become more scalable and more repeatable, and institutional investors invest more and more in these asset classes, more data points are created and more track record are built, helping to correct this overestimation of the risk, converging the perception of the risk to the reality of the risk, meaning that we would need less amount of public money to mobilize more private private capital, and it creates a constructive, positive feedback loop that I would say hopefully in 5 to 10 years, we would be in a position that this asset class is a normal asset class that we invest at a scale regularly. They are expertise in all investment teams that work exclusively on this asset class. And then in 5 to 10 years, we are discussing about something very different.
I hope to invite you again in 5 or 10 years, actually rather 5 years. Maybe then at that point in time we will be speaking not about the how to do it, but what has been done and how this can be even further grown. For today, I think we're done with what we wanted to discuss, although there's much more, and Mostafa and I can have very long conversations, as we know from the past. So thank you very much for taking the time. Thank you for this very insightful discussion on the scale of the opportunity. Finally, we're also looking at the opportunity, which I find very positive and helpful. These themes, both resilient infrastructure and resilience infrastructure, as we've learned, sit at the core of our Resilient Infrastructure series. And you can find further information on the campaign on our website. Thank you again very much, Mostafa, for being here today and for the great conversation.
Thank you.